Saturday morning to you, and welcome to On the Mark. Alongside Mark Papa, I'm Gary Byron. Mark is the president of Financial Resources Group. They are out of Glastonbury, Connecticut. You can find them online at www.frplan.com. F as in Frank, frplan.com. I want you to write this phone number down. More importantly, I want you to call it 860-657 8380. I want you to call. You can call it now. Of course, Mark's a little tied up at the moment, but at the end of the show, you'd be one of the first 5 callers. He's got something real special. In fact, it's a $2,500 value. But what you're personally, I know what it entails. I actually thought that's a low number. I know $2,500 is a lot of money. I think it's worth even more than that. What this will do for you, but I'll let him better explain it. Let me give you this number one more time. That's how important it is. 860-657-8380. Mark, good morning. Nice to see you.
Hey, good morning, Gary. How are you?
Oh, hey, I am peachy this morning. What are you up to?
Well, it's always great to be here with your listeners. Just grinding.
These are your listeners, my friend. You've earned your audience.
Yeah, it's been good. It's just grinding through the summer, and grinding through the summer. We're starting some new programs at the firm, doing lots of updates to become, a lot of security updates and just sort of. Just a lot of different updates, a lot of upgrades. It's been good. It's been a great experience, actually, since I've taken over the company. And we're just bringing things up to speed, bringing things up to code, per se. Not to say that they weren't before, but we're just being extra cautious, and there's a lot of identity theft and all that fun stuff. So we're just upgrading all our security systems and just making sure everything's up to snuff. So we've been doing a lot of that kind of stuff over the summer, along with meeting with clients. Summer's big for client reviews. So we feel that we love doing our client reviews in the summer because we're not busy trying to market or do these other things. So it's great. So just lots of client service, lots of coming up with new ideas, better ways to serve our clients, that fun stuff.
Who is your most ideal client?
I wouldn't say that we have one. I know I'm basically looking for people with at least $1 million or more now. But there is really no ideal client. Someone that really needs help, that wants help. Someone that we know appreciates the help that we can give them. The people we don't like are just the serial shoppers and, people who are just there to, pick our brains and stuff. They're not our kind of people, so I've kind of learned how
Can you pick them out? Do you know?
Well, no, I mean, a lot of those people, believe it or not, I can convert to real clients and let them understand that they have very unique issues and very unique problems that they never even were understood, and that's what the full checklist does. So I'm not so worried about that. But it just at the end of the day, I think we're just looking for people that maybe had an advisor that grew their money but doesn't know how to do the income, or and then in the next show that we do, I'm going to talk about Social Security timing, and that sounds like a very, very generic term, but I'm going to turn Social Security timing on its head.
There you go.
And tell you what every other conventional wisdom advisor tells you. I'm going to show you a better.
But
way.
That's next week. Let's do a little teaser.
Next week. That's the teaser.
If someone listening to this right now saying, I've been listening to this guy, he's really smart. I really respect his. But boy, I don't have $1 million I can't sit down with the guy. It's too bad because I really would like to. What would you say to that person?
Well, I mean, that's for married couples. So if you're single, whatever, you have $500,000, and then we could work with you in that percent. We don't turn anybody away. I'm just saying that's who, my ideal client at a minimum, that's who we want to work with. The markets have grown tremendously. Assets classes, gone up a lot. So we want to focus on, people at higher, we want to work with people with more money. That's it. And that's the bottom line. And with all the work that I do for people.
Well, I already know that.
We're doing probably double, triple what your average advisor is doing for their clients.
Very true.
You're going to get your value out of that. So it's hard to do with somebody with $250,000 because they're very frozen. They're afraid to make decisions.
Sure, I understand that as well. Before we get into the meat of the show today, I want you to do two things. I want you to do the disclaimer because we always run out of time, and it's so important that it gets on. Yeah. But I also tease something where
because we got a long show today. So
and really one of the first 5 callers at the end of the show. I'll repeat the number a few times and points of contact a couple of times before the show's over. But I mentioned this value of $2,500. I think that's a conservative conservative number that's very fair for you to say, I think it's worth more. What exactly are they receiving for this $2,500
It's a 21-point checklist of things that we cover. We're doing non-financial things. We're making sure your power of attorney has the proper language to work with Social Security, because it doesn't right now. It may not work with your bank or brokerage firm. If you're incapacitated, you can't get your money when you need it most. We're also looking at home insurance right now. I did that show a couple weeks ago, how the top 5 companies, they're denying claims like crazy. We want to make sure that you go to your agent. We have a special form, a checklist that you can bring to your agent to make sure your policy will actually pay those claims. And most people just ignore that. They brush it off until there's a problem. We actually prevent the problem from happening, because that's tens of thousands of dollars. Forget about $2,500. That's tens of thousands of dollars you may have to come out of pocket, take it out of your brokerage account, or take a loan on your house just to cover that the insurance company should have covered for you. Or you have to hire a publisher adjuster, who's going to cost you $10,000. So we're very, very thorough, preventative, and I don't even get paid to do those things. I don't sell that type of insurance. I have to go through it with a fine print, with a fine-tooth comb. So I hate doing those things just as much as you probably hate gathering that stuff. But, what kind of advisor would I be? If you get nailed with a $30,000 bill that your insurance company said you thought were going to cover and they didn't. So we're doing that. Then we're looking at hidden fees, unnecessary costs, unnecessary taxes, high turnover, fees that you were never shown by your advisor.
Wow.
And those are the areas where we really shine and help you uncover.
And this is all minimum $2,500 value. People are getting this for zero, just to sit down and meet with you. It's really into their advantage that they do this. Before I get into this, let me get that disclaimer out of the way, because we always take this show right up to the last minute.
Yeah, and we have a lot to cover, all right. So the information presented in this program is for educational purposes only and should not be considered personalized investment advice. Financial Resources Group is a state registered investment advisor in Connecticut. For more information about our firm, services, fees, visit www.frplan.com or request a copy of our Form ADV, which contains important disclosures about our business practices, qualifications, and potential conflicts of interest. Investing involves risk, including the possibility of loss of principal. Past performance is not indicative of future results. Always consult a qualified financial professional before making investment decisions.
All right, Mark, you told me before the show that you've given today's episode a name. And I gotta say, it actually got my attention. You're calling it the double bubble.
Yes,
all right,
I am.
What are the two bubbles then? Let me start there.
Okay, the double bubble is this. The data center CapEx spend, capital expenditures, the giant spend on data centers, the stretching of the balance sheets of the top hyperscalers, the Metas, the Amazons, the Googles, the Facebooks, whatever. The stretching of their balance sheet. I'm going to go through the details of that. I think that trade is getting tired. I think that, and you couple that with the private credit market, which is also, I see a bubble there. There are lots of cracks in the armor in private credit among the private equity firms. There's multiple different stories. I could do a show just on the stories alone, which I probably will do maybe two to 3 weeks out, because I want to see how certain things materialize, especially with Mark Walters, who is the owner of the Lakers. He had to dump the Lakers just to cover his cover some debts.
Isn't that crazy?
He's self-dealing, at the end of the day.
But the Buss family is still going to own like 17 or 18% of the Lakers, right?
I guess. I already thought they sold it to him, but whatever. So let's just talk about the fact. I see the crash of 2000. I see the 2000 tech bubble, even though valuations are lower now. I think the CapEx spend is just way overreaching. It also meets the crash of 2008. So I see a tech crash and a financial crash happening at the same time. And the reason I see that happening is that they're so intertwined now. They're highly, highly correlated, where in the past they weren't so correlated. You had the crash of 2000. It was a tech wreck. And then you saw the banks blow up in 2008. It was only, 6 years later that the banks blew up to insane levels in 2007. And you saw a huge train wreck in the housing market. So I see also some of the creative financing about to happen with that $500 billion facility NVIDIA is trying to put together. Seems very, very similar to, very, very similar, Gary, and I'm going off, very, very similar to some of the creative financing that they use in the mortgage market, and that the banks were buying these exotic credit instruments and leveraging up their balance sheets like crazy. That blew up the banks and the bad mortgages, the covenant light loans. You could take a look at private credit, where some of those loans could be not as stringent as they normally would be if there wasn't so much money chasing private lending. So we have to be very, very careful. And on the technology side, I see very similar parallels as well. So why don't we get into it?
All right, just let me make sure I understand this before we get into it. Are you saying the money bubble is funding the building bubble? Do I have that correct? Or because that's what it sounded like.
Yeah, exactly.
Okay.
They're both
right.
there. So this is kind of exactly.
All right.
Yeah. So instead of venture cap, exactly. So that's exactly right. And it's the one word I want listeners to remember today is correlated. That means when two risks are correlated, they don't fall separately. They fall together. Or correlated means they're both alike. Okay? And I think there's just way too much correlation going on there. And that's the part I really want people to hear, Gary, is it would take a crash. It would only take a crash in one of these markets, whether private credit or a slowdown in data center spending or the inability to finance data centers to slow down the chip stocks. So you have to think of this is a very sensitive time right now with all the money being spent. I think people are clouded. If you just look at the facts, I'm starting to see that the potential for them to continue financing these data centers is starting to slow down. We have rising interest rates. We have cost of chips going up. We have bottlenecks. And I'm not saying it's all going to blow up. I think there's going to be survivors, but I also think there's going to be losers as well. And we haven't seen that yet. Just like any other build out, call it a bubble, call it a boom. Bottom line is there's going to be a reckoning at some point. And if one of those things were to fall out of bed, whether it be the technology side or the financial side, I think they both come crashing down at the same time.
Wow. Okay. Wow. I mean, so you got creative financing versus traditional lending. Hold on to that phrase, folks, because it's going to all come. It's going to come back all up.
And I think that.
And you've been seeing this movie before. I know you've seen this before.
Yeah, and I think what scares me the most is the fact that NVIDIA is partnered with the 6 largest names on Wall Street: Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. Many of these companies are very tied into the private credit market. Many of these companies own insurance companies that they've borrowed money for, or actually put their private loans on the books of the insurance companies they own. So I see a lot of potential for a systematic risk all over the place, not just in tech, but also if you take a look at, they want to do a $500 billion facility for an infrastructure financing platform, mobilizing third-party capital so the customers can build these data centers and buy the chips, while NVIDIA caps its own backstop at roughly 25% of the deal. But think about this. NVIDIA is doing this to keep the sales of and demand for their chips going. In my opinion, that feels a little bit inorganic or disingenuous, because if people really want their chips, they'll find a way to pay for them. But then here they are creating credit facilities to get other companies to invest so that they can build more data centers to buy their chips. That is a red flag to me. Although, okay, and I'm not crying wolf. I'm just saying that's a red flag. That's something we have to be very, very, very careful of. The next thing we want to watch out for, remember Enron. Enron was doing some bad stuff. They were using special purpose vehicles and offloading bad debt into those special purpose vehicles. In this case, what's happening, these data centers, a lot of the debt that is being used to finance these things, a good example is Blue Owl Capital, who is a private credit lender, has a special purpose vehicle that they own 80% of, and I think I can't remember the company. The other company owns 20%. Those are off balance sheet. You don't even see them in their annual reports. They're third party vehicles that were created to help create these finance facilities to build out these data centers. So there's a lot more risk out there that is being advertised, and that's why the Wall Street Journal just yesterday, I think, or 2 days ago over the weekend, said why big tech's AI spending is $3 trillion higher than it seems. And there's just a lot of, this is a very extensive article. We're going to do a whole show on this as well. But if things go wrong, it's going to be a monstrous debt burden on many of these technology companies. I just don't see it ending well at all. We hope everything goes well, Gary. That's what we do. We hope for the best and plan for the worst. But these are just some red flags that I want to bring up. And I would ask people, even if you don't want to come in for the checklist, come in for a stress test of your portfolio to see how much risk you're taking right now. And I'm not talking about a simple questionnaire. I'm talking about stress test your portfolio to see what it looks like against these hyperscalers, what it looks like against these private credit companies. What does it look like in a 30-40% downturn, and can you survive that if you're about to retire? And that's something that we can also do for you as part of that checklist. And I think that's important now.
Sounds pretty detail oriented.
Yeah, it is. I mean, but the bottom line is you need to know whether you can. If you retired in 2000, Gary, and you retired in 2000, 2020 to 2010, the market technically returned 0%. If you were pulling money out during those times, you can essentially, by 2019, you could have run out of money. It's called sequence of return risk. So those are things that we want to protect people from. The markets have been great. Everybody's been popping the champagne bottles. I'm sounding the alarm bells now, and I'm bullish, Gary. I'm a stock guy. I'm a money manager. I mean, I run a model portfolio. But we've diversified away from the Mag 7, and we did a long time ago. We've benefited from that. Our clients have benefited from that. But these are things that I want to start bringing up. People need to know this. If your advisor's not talking about these things, we need to have a chat.
So you got creative financing, traditional lending. You sounds like you got a lot going on.
Well, traditional lending was you can go to a bank and get a loan, right? Put down 30%. We're going to finance the rest 70%. We're going to have covenants in there. We're going to have draw schedules and all sorts of different, rules and regs to make sure that you're doing the right thing by the money. But that's now it's this private credit that, a lot of people don't really, there's a lot of sophisticated people in the private credit market doing these loans. These are, private equity. Many of these, they're all mostly Ivy League and super smart people. But there was a lot of super smart people during the dot-com bubble that I saw lose lots of money. Stanford graduates, Harvard graduates with these startups. I saw a lot of people lose a lot of money for people. There were a lot of smart people who created those mortgage-backed securities and those wild derivatives and those, CDO squareds and those structured notes in 2008. A lot of smart people, and a lot of people lost lots of money based on that. Now, what they did is they cashed in before the crash happened. Yeah. So, that's what they did. So,
folks, you're listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group out of Glastonbury. You can find him online at frplan.com. More importantly, he's talked earlier in the show about this a very, very thorough what would you call it, a checklist, or what would you call it, tune-up, or
no, it's the full checklist.
You got everything. It's call this number 860-657-8380. It's absolutely free. It's worth at least a minimum of $2,500. And be one of the first 5 callers. There's no charge for you. 860-657-8380. Mark, you have lived through. You just mentioned the .com as well as the telecom bust. And you've lived through that as a professional. Maybe walk us through what happened then and why today kind of rhymes with it a little bit.
Well, there's just too many. There's just a lot of parallels here, Gary. There's just a ton of parallels. Again, I saw how the banks crashed. I saw that they wrote mortgages to people who shouldn't have gotten them. I saw in technology, I saw companies go public that shouldn't have been public yet, that weren't profitable. That's not the case today, but this is a different kind of bubble. And I'm just saying the parallels are there when you look at the telecom build out even. They built out, fiber all over the world. And there was this whole period of time where all the fiber was dark, and now it's at full capacity. But it took a long time. There's a lag. There could be slack in the system. My fear is that maybe they overbuild these data centers.
It sounds like they did.
Maybe enough can't be built. But the reason, the motive for what they're trying to do to get more financed is to sell more chips. And NVIDIA is acting as the bank. So you're the bank, and you're lending money to Oracle, and then Oracle's buying your chips. Think about that for a minute. So you're basically, it's kind of interesting. That's all. It's what they call this.
Musk wants to put these things out in space. Did you hear that?
Yeah, I have been watching that, and I think that could be very, very disruptive to all these data centers on land. Alone, if you look at the Louisiana facility, the Louisiana facility for Meta, Gary, is 1,700 football fields large. 1,700 football fields. That's massive. Not 17 football fields. I'm talking 1,700 football fields large. Okay, so that's how massive it is. And they're going to, obviously they're going to want to lease space in these data centers and make a lot of money. But again, it's all based on future expectations.
It's all circular money too.
Well, that's all circular money. Yes, exactly. So, but we can get back on track in terms of how big the build out was. Like last year, it was 600 billion. Now they're projecting 750 to 800 billion annually. It's just a very, very big numbers. Now, Gary, I want to go back to 2008. Remember how big the Obama stimulus was?
Oh, right. Yeah.
How big was that? Do you remember?
I remember the stimulus. I don't remember how
it was. I think it was 800 billion, Gary.
Was it
the
that
stimulus to protect the economy from the financial crisis? The stimulus checks, the infrastructure build was $800 billion, almost $1 trillion. That's literally next year's data center spend, Gary. Think about how massive that is. I mean, it's great for the economy, but how sustainable is it? That's what we have to start questioning. We have to start poking holes in this narrative, into this. Have to start poking holes into this a little bit. So we can't just be 100% bullish all the time, and that's why I'm doing the show. I'm saying we have to start questioning exactly what's going on.
What about bubble number 2, private credit?
Well, I would say that private credit is, again, there's been some bad press on private credit. There's been some bad loans. There's been some, going back almost a year and a half ago now. There was some fraudulent loan that was, I won't get into that, but we're starting to see more and more potential for defaults in the private credit market. And if you look at the private credit lenders, and you look at their stock, if you look at some of the private credit facilities, I can't remember the name today, but somebody had just cut their dividend. You've seen people in these private credit funds who aren't able to get their money out. They're only able to redeem a little bit at a time. So people, so it's interesting. It's just an interesting time. We don't really know, though, what is in many of these funds. We don't know exactly, how they're actually financing things. And again, the Wall Street Journal, I'll do a whole show on this, that why big tech's AI spending $3 trillion is $3 trillion higher than it seems. But it shows an amazing graph about how these things are being structured, and it's just not conventional, and we're talking massive amounts of money. So all I'm saying is, from my view, a lot can go wrong.
Oh, you had mentioned something at the top of the show. I just want to go back to it, maybe take a deeper dive into the NVIDIA deal, because it seems to sit right now at the center of your double bubble, right?
Well, yeah, that was what really triggered the show, Gary. And then prior to this, though, these cash risk companies were able to finance off their own balance sheet. They had the cash flow, or they'd ever to do a bond offering, and now they're looking to third parties to do it. So that's kind of like what scared me a little bit is NVIDIA is now going to third parties. They're talking to every major sovereign wealth fund all over the world, where before, basically what I'm saying is these big companies that used to be cash flow positive, meaning they had more cash flow versus above their operating costs, are now technically cash flow negative because of all the debt they've taken out to build these data centers. They're really stretching their balance sheets and really leveraging up their companies as if they're startups again, to go after this build out. And it's a giant land grab. So, and again, I think AI is going to have a great benefit for a lot of people, but
to be fair, NVIDIA says it's this actually reduces the circular financing concern, that they cap their own backstop at around 25% per deal, and that the credit risk shifts off of NVIDIA's balance sheet.
Well, we'll see how it plays out. We're going to see how it plays out because, I think the other side of it is the profitability end of things too. So let's take a look here. There was this gentleman by the name of David Kahn at Sequoia Capital. And he's one of the most respected venture firms in Silicon Valley. And he's an AI bull. He's not a skeptic. He likes AI. And he published a structural analysis he called AI's $600 billion question. His math goes like every $1 spent on a chip requires roughly $4 in total ecosystem revenue to be a sustainable, profitable model. So $1 spent on a chip needs $4 in total revenue to become a sustainable, profitable model. Because at the chip, that's just the start. You have the data center around it, the energy to run it, the cloud providers and the AI companies on top of each other, all the softwares, they each only their own margin. And you stack those layers, and $1 of silicon is about $4 of revenue just to pay for itself. So think about that for a minute.
Jeez.
You know?
Wow.
So that's where it kind of gets quite sobering, right, if you put it together. And now you run it against a combined hyperscaler spending of $750 to $800 billion a year going forward. And now $4 of required revenue for every $1 of chips means the ecosystem means in the order of $3 trillion, Gary, $3 trillion in AI revenue to break even on this whole build out. All right. So we're talking massive
Big
numbers,
bucks.
Gary.
Yeah, we are.
And again, a small delta on $3 trillion is a big number. We're talking $3 trillion. So you're off by 1%, Gary. That's a huge, that's a lot of money. Right, so this is the kind of thing I want to start poking holes in this argument that people need to be diversified. You can't just have, your portfolio, whether you know it or not, 30 to 40% of your portfolio is tied to this trade. If you're in the S&P 500, if you're in the Vanguard Total Market, there's a big percentage still of your portfolio could be tied to this trade. If you're in bonds and interest rates are going up, or you're in bond funds, your bond funds are not looking very, very good right now. And we need to stress test both your stock funds and your bond funds.
I'm glad you brought the stress test up.
The 30-year Treasury is just starting, it's come back down a little bit. It went up to 5.3. And that's not good for your long-term bonds. That's not good for your target date funds. That's not good for your diversified bond funds. That's not good for your growth and income funds, because oftentimes I find dividend stocks mixed with bond funds in some of those blended funds, and there's a lot of 30-year treasuries in those. So you can lose your shirt if you're not careful, and that's why you need to come in and get some kind of stress test and let me review it. Not somebody's software do it. It's a third-party software we use. Let someone who's actually built successful portfolios and actually made money and actually beat his benchmarks a bunch of times, like we are this year, who can actually sit down with you and really put that together the right way and show you where the problems are and then find out why those problems persist. Because whoever built the portfolio is the one responsible, not you, if you're paying an advisor.
You want this stress test? You want this financial stress test? How would you like to get it for nothing? And Mark's time is valuable. Well, you've got to be one of the first 5 callers right now. Right now, as we're wrapping the show up. Here's the number. Write it down. But more importantly, call it now, because the first 5 will receive this financial stress test absolutely free. It's a $2,500 value. 860-657-8380. One more time, 860-657-8380. Mark's office is Financial Resources Group in Glastonbury, Connecticut. You'll find them online at frplan.com. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.